like Brazil and Russia and all of that, and started looking toward where the next crisis was going to be, and like the detective who's trying to triangulate where the serial killer will strike next, and finds that this guy is hiding in her basement, Nouriel found that the next target was going to be the United States. So he's here to talk more about that.
There are several questions that are on everybody's mind, of course. This crisis was defined, I think, correctly as the worst financial crisis since the Great Depression. So the first question that George actually addressed very well is the question of the cause of this crisis. A related question is, are we at the bottom? Are the policy actions being taken in the last few weeks necessary to avoid a systemic financial meltdown? And are we at the point in which financial markets have bottomed out, are going to recover from here, or is still the worst ahead of us? That's a certain central and key issue. The second question, of course, is then the implication of this financial crisis for the real economy. I think at this point it's clear that the debate is not anymore on soft versus hard landing for the US economy. We're in a recession, but the debate is on how hard the hard landing is going to be. 6 months ago, the optimists were suggesting this is going to be a short and shallow recession, V-shaped, 6 months, brief fall and then rapid recovery. I've been arguing for a while this is going to be much more long, protracted and ugly, something like more like a U-shaped recession lasting 12 to 18 months, maybe even 24. And 6 months ago, the probability of a more severe stagnation, something like an L-shaped stagnation like the one that Japan experienced after the bursting of its real estate and equity bubble in the 90s, was a very low probability. But today we're in a situation in which the V is out of the window. This is not going to be a short and shallow recession. We are already in a recession that's going to be quite severe, and we'll be lucky if it's just a U-shaped lasting 18 to 24 months, unless we really fix the financial system, unless we do right policies. There is a meaningful also risk we're going to end up in a multi-year economic stagnation, something much worse than we've seen in decades. The third question I think it's crucial and important is also what is the outlook for the rest of the world, not just for the United States. And here the bad news is, while 6 months ago it looked like the United States was the only country that was entering a recession, when you look at the data from the second quarter of this year, so even before the severe financial shocks of September and October hit US, Europe, and other countries, but the numbers from the second quarter of this year suggested that not only the US was entering a recession, but also the entire Eurozone was entering a recession, that the UK was entering a recession, that the rest of Europe was entering a recession, that Japan was beginning to have an economic contraction, that Canada was starting to have a recession. Essentially, about half of all GDP in the world, almost all of the advanced economies, were entering a recession already in the second quarter of this year, before these very severe financial shocks have now reduced confidence, have led to even a worse financial crisis, even a more tight liquidity and credit crunch than before, and therefore going to make the economic contraction more severe. So at this point, we're going to have an advanced economy recession, and the remaining question mark is how much of a slowdown in growth is going to occur in the rest of the world, especially in emerging market economies like the BRICS countries, Brazil, Russia, India, and China. How much of a contraction in growth is going to occur in Asia, in emerging Europe, in Latin America, in Africa. And I think that given the shocks that have occurred in advanced economies, if you look at the channels of transmissions, the idea that the rest of the world could decouple from the United States was far-fetched to begin with, and now with the economic contraction being severe, then trade channels, credit channels, financial channels, commodity channels, currency channels are going to imply a very severe recoupling of economic growth, even in emerging markets economies. And unfortunately, people usually say when the US sneezes, the rest of the world catches the cold, given the financial and trade links. And this time around, the US is not just going to sneeze, it's going to have a severe case of pneumonia or something more severe than that, and therefore the transmission to other countries in terms of financial transmission has already occurred, and the real transmission is going to be also very, very severe. Now let me say something about the nature of this financial crisis. I think that George Soros gave you an excellent kind of introduction to what happened, and I want just to elaborate on some of the points to just get a sense of what are the key issues. He said that a major asset and credit bubble in the US economy, not just the US economy. That's absolutely true. A process of re-leveraging both of the real economy, households and other institutions, and of the financial system. What led to that? Many factors, but certainly one of them was policy mistakes by the Fed. During the last recession, after the bursting of the dot-com bubble, the Fed aggressively cut the Fed funds rates from 6.5% down to 1% and kept it too low for too long. All the way to 2004, the Fed funds rate was at 1%. So you had easy money, you had easy credit, you had a situation in which investors were essentially underpricing risk, and there was also very lax supervision and regulation of the financial system. This kind of excesses in the financial system would have not occurred if the regulators had not been asleep at the wheel and letting all this toxic underwriting in mortgage and otherwise occurring. They really did let it occur because the ideology in Washington for the last few years was one of self-regulation, that means no regulation in financial market, of markets discipline, but when there is euphoria and irrational exuberance, there is no market discipline, of reliance on internal risk management models, but as the previous CEO of Citigroup, Chuck Green, said, when the music is playing, you got to dance, and therefore nowadays caring about the internal risk managers, because everybody is investing and taking risk. And then also reliance on rating agencies that were having severe conflicts of interest because they were essentially being paid by those people that were supposed to be rating. So literally it was a system of relying on self-regulation, market discipline, and principle rather than rules that miserably failed. And it's a lesson also about how regulation and supervision should occur. So that was a key element of creating the bubble. Easy money, easy credit, underpricing of risk.